What's up, everybody? Dan again, Stocktrades.ca. Welcome back to the Stocktrades YouTube channel. Last week, we went over a ton of top Canadian dividend ETFs. If you want a link to the video, I'll post it above. But a lot of people were commenting, and actually we had a ton of positive reaction on that video, so much so that we're going to continue making ETF videos. It's not going to be every video, but we are going to add them into our, playbook of videos. And this week, we're going to continue going on with more Canadian ETFs, and I want to focus on a sector that was pretty heavily featured in last week's video, that being the financial sector, but instead I want to focus on Canada's big banks, because over the last while, there has been a ton more Canadian banking ETFs that have come to the market, and Canadians actually have some choices right now as to which big bank ETF they want to buy. So with that being said, in this video, I'm going to go over some of the most popular options in the country, which ones I like best, which ones I don't like that much, and overall, you're going to get a grand sense of the exchange-traded funds available for the strict focus of Canada's big banks. So let's get started. So, a while back, I actually wasn't a very big fan of many of these Canadian banking ETFs, but now that some of them have cut fees down, it's starting to actually make sense to some to own these Canadian bank ETFs in their portfolios. Now, for somebody who is on a commission-free trading platform, especially one that allows for fractional shares, most of these ETFs can be mimicked, relatively easily, because they only contain, some of them 6 stocks. You can buy these 6 stocks commission-free. If you have fractional shares, you can actually tune the allocations to be absolutely identical to the underlying ETF, and you can actually save fees. But if you are with a commission brokerage, or you absolutely need the monthly income that a lot of these provide, because all of Canada's big banks pay quarterly dividends, but with these ETFs you do get, for the most part, a monthly distribution, they can make sense. So I'm going to go over some of the most popular options in this video, but before I do, I want to remind you to smash that like button and head down below and subscribe to the channel. A lot of our watchers are not subscribers. A subscription helps support the channel, helps us create more great videos, and of course, if you like the video, comment and subscribe, you'll be entered to win that Stocktrades Premium giveaway. But let's turn the screen around to my computer, and I'm going to go over some of Canada's most popular banking ETFs. So let's look to the bullish case for Canada's banks. So during the 2008 financial crisis, Canadian banks were one of the very few that didn't cut or suspend their dividend. They didn't raise dividends, but they at least kept their heads above water. And you're seeing, companies like Bank of Montreal and Royal Bank of Canada, they've paid uninterrupted dividends since the early 1800s. And one of the major catalysts for banks right now is rising interest rates. Now, you could argue that these are already priced in, and that might be so, but these banks likely have more room to run, as there is very likely to be more interest rate increases in the future. So we saw the Bank of Canada and the Fed raise in March, and a lot of people are signaling 5 or 6 more raises in the next year or so. I'm not sure if that will be the case, but there will be more raises inevitably to come. So banks loan money. So when interest rates go up, it's a big positive for bank stocks because they can charge more for these loans. And as such, these Canadian banking ETFs are seeing big demand. So the first Canadian banking ETF I want to go over is arguably the most popular one, and that is the BMO Equal Weight Banks Index ETF. It trades under the ticker ZEB, and the overall objective of this ETF is to duplicate the performance of the Selective Equal Weight Canada Banks Index. So this ETF contains all of the same holdings as the index, along with the same proportions of each holding. So technically, this is an index fund. So at the time of filming, its top holdings are Toronto Dominion Bank and the Bank of Nova Scotia. However, it's important to note that there's pretty minimal difference between the weighting of the holdings in this ETF, hence the equal weight nature of it. Its largest holding is around 18%, while its smallest just comes in at just under 16%. The ETF pays a 3% distribution at the time of filming, and over the last decade, it has returned over 225% to investors who have chosen to just buy it and reinvest the dividends. This works out to be a 12.52% annualized return. So overall, if you are looking for the absolute bare bones, simplest, most direct way to invest in Canada's banks, then this bank ETF is for you. It has an equal weighting, so there's no, bias towards any individual bank. You're just going to get equal weighted exposure, give or take a few percent, to Canada's big five banks plus National Bank. So ZEB used to have a management fee of 0.55, and when it did, I was pretty much telling people that this banking ETF was not worth investing in. Why would you pay $5.50 per $1,000 invested when you could just mimic the holdings very easily? But they actually slashed its fee to 0.25%. So this makes this ETF very attractive now, as the fees have been slashed to the point where you just pay a little over $2 per $1,000 invested every year to own this fund. So along with the reduction in fees to 0.25%, you also get a monthly distribution. So all of the banks inside of this ETF pay quarterly. So to somebody who needs the monthly income, the 0.25% fee every year to get a monthly distribution might be worth it. So the next ETF I want to go over is the RBC Canadian Bank Yield Index ETF. So this is a Canadian banking ETF from RBC that aims to track the Selective Canada Bank Yield Index. So compared to ZEB, which was equally weighted, RBNK is not equally weighted. In fact, the bank ETF aims to provide enhanced dividend yield for investors, and as a result, it is kind of yield weighted. So the largest holdings inside of this ETF are Bank of Nova Scotia and Canadian Imperial Bank of Commerce. They are some of the highest yielding bank stocks, and as such, they are given priority in this fund. So much like the other pure bank ETFs on this list, this fund only has 6 holdings. It's got the Big Five and National Bank. And, of note, despite National Bank being one of the best performing banks here in Canada over the last, half decade, it is the second lowest allocation in this fund, and this is likely due to its outperformance and thus lower yield. So, as we mentioned, this fund aims to increase income. Now, interestingly enough, the fund currently has a distribution of 2.96%, so it actually yields a little less than ZEB. And in terms of total returns, it has turned out 11.81% annualized returns since its inception in 2017. So $10,000 into RBNK would be worth around $17,500 at the time I am filming this. So in terms of fees, it has fees of 0.33%, which means you'll pay about $3.30 per $1,000 invested on an annual basis. So this used to be a strong alternative to ZEB because of the fee structure. The fees on ZEB were quite a bit higher. But now that ZEB has lowered its fees, it's actually a lot more competitive. This has assets under management of $287 million compared to, over $1 billion for ZEB. So it's one of the smaller and actually one of the most unknown banking ETFs on this list, but it's still got plenty of liquidity for Canadian investors looking for instant exposure to Canada's 6 best banks. So the next ETF on this list, and I'm sorry, I am cheating a little bit for this one, and it is the iShares S&P TSX Cap Financials Index ETF. It trades under the ticker XFN. So I put this ETF, on this list because it isn't necessarily a fund that focuses exclusively on Canadian banks, but I felt it needed to be included nonetheless because it still has significant exposure to Canada's banks. So this fund tracks the Cap Financials Index, which is made up of, a bunch of Canadian corporations that operate in the financial sector. So Canada's Big Five make up a ton of this sector. If we're looking at the top 3 holdings in this fund, they're Royal Bank, TD Bank, and Bank of Nova Scotia, and they make up half of this fund's assets. So the Bank of Montreal is also within the top 5 holdings, making up around 9% of the ETF at the time of filming. The National Bank of Canada is tucked below a few insurers in this fund and, is the only Big 6 bank with a sub 4% weighting. It does contain some exposure to lower yield insurers and asset managers like Brookfield Asset Management, so it does only yield in the mid 2% range at the time of filming. However, this fund, it has outstanding performance. It's got 11.7% annualized returns over a 10-year time frame. So that means if you had invested $10,000 into XFN and reinvested the dividends a decade ago, you'd be sitting on returns, in excess of $30,000. Now, this is a little more niche fund, so fees do come in a little higher, $6.10 per 1,000 invested, or 0.61%. So although it's not the cheapest fund, it's certainly not the most expensive either. And, for its part, it has managed to produce one of the best returns out of any fund on this list. So it's not a pure big bank, Canadian bank ETF, but with its massive exposure, over 50% of the fund is Canadian banks. It's something for somebody to consider who wants exposure to not only Canada's big banks, but the entire financial sector. And it contains, some very blue chip holdings, such as, Manulife Financial, Great West Life, Brookfield Asset Management. So something to consider if you kind of want more variety. So next up, I have a couple, specialized ETFs, one of them being a covered call ETF and the other one being a leveraged ETF. Now, I've expressed my dislike for covered call ETFs. I'm not a fan of them. I've mentioned it in a lot of videos, and I've also made a video exclusive as to why I think covered call ETFs are, correct for a very small portion of the investor community. And other than that, you might be sacrificing overall returns in your portfolio. But there is no question about it. These ETFs have exploded in popularity post-pandemic, especially. Before the pandemic, I rarely ever got emails or inquiries about these ETFs. And now, over at Stocktrades, we get them on a daily basis. We're going to go over ZWB, which is the covered call Canadian bank ETF. So this is primarily for Canadian investors that want exposure to the Canadian banks, but they want to essentially juice up the yield. And they do that by selling covered calls in the portfolio. So a call is a type of options contract, and the covered portion is a option strategy where the investor, or the fund in this case, owns the underlying stock. So they will sell call options for the same number of shares or less that they own. And with a call option, you pretty much agree to sell the shares determined within the contract for a specific dollar value if it hits that price point. So you get paid a premium for selling the contract, and ultimately, if the contract expires, you keep your shares and the premium. So say you sell an options contract that gives the buyer of that contract a right to buy TD Bank at $100 from you. They're going to pay you for that contract. And if TD Bank, at the time of expiration trades at, $105, they're going to exercise that options contract, and you're going to have to sell them TD Bank shares at $100 a share. Now, if TD Bank trades at $95, they're obviously not going to exercise that option and pay you $100 a share. So that option expires, you keep the premium, and as such, you've generated, some more passive income. Covered call options, they're the safest way to trade options, and someone who is skilled in this strategy can really lower overall volatility and increase income. But covered call ETFs are notorious for underperforming in bull markets. This is primarily because if stock prices go up, it's bad for sellers of call options. And this is why, if we look to this chart, you've seen, over the last 10 years, ZWB has outperformed ZEB, which is the non-covered call variant, by about 2% annualized, which is actually a significant amount of returns. I mean, if we look to $10,000 invested in both these funds a decade ago, you've got around $26,000 in ZWB, and you've got around $33,000 in ZEB. And this is with distributions reinvested. So ZWB is not a poor banking ETF. It's just critical that you know what you're buying before you buy it and see if it fits your investment style. The fees with ZWB are going to be higher. They're about $6.50 per 1,000 invested, but the distribution is actually much higher, yielding around 5.46% right now compared to, the low 3% range with ZEB. There has been a ton of fund inflows over the last year to this ETF, as a lot of people want to gain that passive income option. But just understand, if Canadian banks do continue their, bull run, this ETF will underperform ZEB in terms of total return. So the last fund we're going to go over on this list, and it's actually a very interesting one. It's brand new, just came out on October 14th, 2020, and that is the Hamilton Enhanced Canadian Bank ETF. Now, before I even get into it, this fund does use leverage, which means, say the fund had $1 million, they are using leverage to invest $1.25 million. There is, modest leverage of 25%. It increases the dividend yield, and it also increases growth potential. But what a lot of these funds won't mention is obviously leverage is good until it isn't. It's worked out very well because, Canadian banks have been on a huge run. But as soon as things start to drop, leverage kind of gets amplified in the other way. So this is important to keep in mind, that you are leveraged inside of this fund. And the leverage is also one of the reasons why it's able to yield 5.4%, and it pays out a monthly distribution. Now, what this fund holds is actually the Hamilton Canadian Bank Mean Reversion Index ETF. So mean reversion is a very popular strategy with Canadian banks. Essentially, it gives exposure by attempting to rebalance the portfolio every single quarter and investing 80% of its portfolio in the 3 banks that have underperformed, and 20% goes to the 3 banks which have outperformed. There's been very strong historical analysis done that states that the worst performing banks tend to be the best performing moving forward. So that's why this is actually one of my favorite Canadian banking ETFs, because it utilizes, it isn't just some basic banking ETF that includes the 6 of them, you collect the distribution and so on and so forth. This is a ETF that actively attempts to outperform by utilizing a active investment strategy and taking advantage of underperforming banks. So as a result, it has outperformed covered call and equal weight strategies by 950 basis points and 100 basis points in 2021. Now, keep in mind, I'm speaking on the underlying holding HCA. So HCAL is simply the leveraged version of HCA. HCA has been around just, slightly longer, June of 2020, I believe it was. But it has 42% annualized returns since inception. It's outperformed every other fund on this list. And it's actually a very interesting play if you're looking at Canadian banks. So, when we look at the top holdings of this fund right now, we can see that the worst performing banks, National Bank, Scotiabank, and RBC, make up, over 25% each of this fund. And then when we look at the best performing banks, TD, BMO, CIBC, they make up, 6% weightings. So this is utilizing this strategy to take advantage of weak Canadian banks at the time. Now, in terms of fees, you're going to pay about 0.65% per thousand invested, $6.50. It's actually, considering its active nature, it's not that bad of a fee, especially considering its performance. So overall, there's kind of 2 ETFs here. HCAL would be for those who want the leveraged variant, and HCA would be for those who don't want the leverage variant. They just want the exposure to this mean reversion strategy. Overall, this is a very interesting ETF and my favorite ETF in the banking sector. So everybody, that's it for the video. These are the top Canadian banking ETFs in the country, and there's way more variety right now even than there was, 3-4 years ago, especially with the HCA and HCAL ETFs I went over. There's more fund managers coming out with unique products like this that give Canadians the ability to gain exposure to the industry and maybe, add some uniqueness to it with the leverage aspect of it and, with ZWB, the covered call aspect of it. But if you're looking for a very basic generic banking ETF, ZEB and RBNK cover that as well. Again, smash that like button, head down below, subscribe to the channel. Make sure you comment to be entered to win our Stocktrades Premium giveaway. We're doing the giveaway next week. It's the end of March already. That's pretty crazy. So stay tuned for more great Canadian content, and we'll see you next time.